Well, good news that the Fed has increased rates today, but you can see here since they did start raising, we've never had quite this spike up. So the thoughts are, as fast as this goes up, is this going to be coming down? So they left that target rate right at 5 to 5.25 as expected, but they did mention, and they're still kind of looking at the words that comes out, that we could actually go as high as 5.6 by the end of the year if the economy and inflation do not slow down. So, but we are seeing quite a few things that make that impact, that show that inflation is slowly coming down. But stuff like used car sales are still up, which is kind of surprising. It just keeps getting better and better. Or for if you're selling a car, more and more expensive if you're buying. So, but it is the first pause in tightening, and that's the key word right there, is pause. So, are they going to continue to decrease? As this goes on and keeps saying, it says it's the first pause in the tightening campaign following 10 consecutive hikes that lifted borrowing cost to the highest level since 2007. So all of these little things, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, that's what got us up there. We were way down here for that 2020 to 2022 timeline. We were way down here with the mortgage back securities and treasuries being purchased, hundreds of millions of dollars worth, billions of dollars of mortgage back securities purchased during this time from the government. So when that stopped, inflation started happening. COVID money started. Everybody was out there. How I explain it, and some people kind of, probably getting tired of hearing this, but there was a party. There was a huge party that free money, and free money creates, no one needing to work for $15 an hour when I can get unemployment. And so August of 2022 had the greatest amount of money ever in history in savings. All that's been depleted. Money's been spent. People are starting to put money on credit cards. So the hangover has to happen. We have to kind of sober up from all of that free money, and that's when we start seeing some rents drop and people go back to work and prices drop on some things and more competitive pricing, and inflation starts slowing down. So it does say policymakers said that holding the target range steady allows them to assess additional information and its implications for monetary policy, but noted they would be prepared to adjust it if risk emerged that could impede the attainment of their goals. The funds rate is now seen higher at 5.6% this year compared to 5.1 projected in March. And then the upward revisions were also made for 2024 from 4.6 down to 4.3 versus 4.3, and in 2025 down to 3.4%. Versus 3.1. And the GDP is seen rising 1% this year, higher than the 4% seen in March. And then while growth for both 1.1 versus 1.2 and 2025, 1.8 versus 1.9. So there is some revisions that showing that the inflation is dropping really slow, but we need it to go a little bit slower. So let's go ahead and take a look at what rates are looking at today here. So we're sitting right flatlined here. You can see, just wanted to point out back here, this was in like January-ish. This was when rates, let me show you a couple charts here. So let's just go like about a year out. So a year out, when this was when rates sitting January. This was when about right here. Is that January? Actually, more like January right here. So in this range, oh no, this January right here. That's too far. Let's go 6 months. You can see back in here, this is when rates got down to 5.99. This is when the market just went crazy at 5.99. Everybody got, pent up demand. People started selling. They did this big sell off after a bunch of inaccuracies were reported and showing that, there's more jobs than there is. Rates, the bond market falls, rates go up. And then we start improving, rates go down, rates go up, rates go down, rates go up, rates go. And over the last, we look at this little since June here, it's just really been flatline. I mean, there's just not enough information to say that we're going either way. There's stuff like the lagging rental income, rents are really what's kind of keeping things slow down. And that means because a lot of rents don't increase until they hit that annual review. So somebody's a lot of people's rent may be increasing, but not during every single month. So the only rents that they do see increasing is when somebody moves out. Maybe they're paying $1,200 a month. Someone goes in, puts 50 grand in there, gets it all nice again. That goes from $1,500 to $2,000 a month, and they say, "Oh, a 25% rental increase," and that kind of is a drastic number, but that's kind of what's happening out there in this market. So as what we need to be looking at in the last, let's say about the last month here. So we just keep bouncing around. We are in a way we're recovering just a little bit right here, but you can see we're, our 25-day moving average is up here. We need to break out of this Fibonacci level that we've just been hugging right here. Once we do, things should be improving a little bit. But you can see let's see, we just lost 12 basis points. So it's all over the board basically today. Whatever the Feds are saying as far as long term is going to make an effect of how this outcome comes. But hopefully we're treading. I mean, I'm seeing mortgage rates sitting today at about 7%. And the 2-1 buy down is giving us the ability to come in and purchase a home today, versus the appreciation. Appreciation has been pretty flatline lately, so really a good time to be buying and take advantage of the 2-1 buy downs with some of the equity, because once these rates get back to that 5.99 level, we're off to the races again. So I hope that makes sense. And anybody have any questions? Bill Black with Northwest Funding Group. Thank you.